Buying land and building a home on it can be easy if you understand how a construction loan works. I'm David Johnson, and I'm a mortgage banker, and today I'm going to talk about what's known in the industry as construction to permanent mortgages. And they're complicated in the sense that most people don't know how they work. Most people that have already bought a home with a mortgage have taken out a 30-year fixed rate mortgage and make a principal and interest payment. But construction to perm mortgages are different because they are used to, in most cases, buy the land and also pay the builder to build the home for up to 12 months, in some cases up to 18 months. And during that time frame, they're just an interest only payment. They're not a principal and interest payment. So I want to make this video to help people that are thinking about buying land and building their dream home understand the process. There are several types of construction loans, just like there are several types of traditional existing home loans. FHA has one, the Veterans Administration has one, there are jumbo construction loans, there are conforming loan amount construction loans, and today I'm going to really talk just in a general sense about what a construction loan is, and then if you're interested in me talking about your particular scenario, then leave a comment below with your email address or a phone number where I can reach you, and I'll contact you and we can talk about your particular situation. When you're using a construction loan to buy the land and to build the home, the way that we want to start off with the pre-qualification is taking that combined value of the land and the construction cost, and that's what you would think of as your sales price in the sense of a normal purchase process of a home. So those two pieces of the puzzle make up the value of your land and your home. So that's what we're going to start off with as your sales price. Depending on the type of loan program, your down payment can vary from 0 to as much as you want to put down. And the down payment is based on that total value of the land and the construction cost. For instance, if it's a $400,000 construction cost and a $100,000 lot, then the combined value is $500,000. So if you're going to put a 10% down payment on that $500,000, then your down payment would be $50,000. If you already own the land, you can use the land value towards that down payment. So whenever I'm talking to customers and they have recently purchased a lot, or maybe they've owned land for a while, depending on the situation, we'll figure out how much that land is worth, and based on that value, they might not have to bring any money to the closing table for the down payment. They would still pay for their closing cost, but they would avoid having to put a 10% down payment if, for instance, the land is worth $50,000 and the home they want to build is worth $450,000. So that's nice when you own the land. Usually that's not the case. Normally people use a construction loan to buy the land and also build the house. Just like normal mortgages, construction loans are based on your credit score. The pre-qualification are based on your credit score, based on your income, and also on your assets to make sure you have enough available money to pay the closing costs and the down payment. So I would go through that pre-qualification process with you and make sure that you qualify for the type of construction loan that is best for you or fits your particular scenario better. And once you qualify for that, then we know that you can actually get the construction loan. One of the interesting things about construction loans is I'm going to actually pre-qualify you for the mortgage payment that you're going to have after construction is done. If you remember, I said in the beginning that during construction, you're going to make an interest-only payment based on the amount of draws that are paid out during the construction process. So your beginning mortgage payment, once construction is happening, is going to be very low because it's just going to be interest-only based on what we've paid for the land and possibly a first draw we paid your builder. Now, as that construction process goes forward and more progress is being made on your home, the builder is being paid more, that interest-only payment is going up. And at the very end of the construction, we would have paid the builder the entire process to build the home. But because the end loan is going to be principal and interest, I have to pre-qualify you for that payment that's going to happen at the end of the construction process. And I'll also add the property taxes to that and estimate on the homeowner's insurance on the payment, as well as private mortgage insurance if you're going to need PMI, depending on your down payment, and flood insurance if you're in a flood zone. And that'll be determined in a lot of regards based on the interest rate. So again, in the beginning of the construction process, you're just making an interest-only payment based on the interest rate that we're going to lock prior to the construction loan closing. During that pre-qualification, we'll figure out, determine you can qualify for the construction loan. And depending on the customer that I'm working with, sometimes they've already talked to a builder And then other times I'll wait until they're pre-qualified. But either during the decision-making process on the construction and how much you're going to spend, or after you've been pre-qualified, you will talk to a builder. You might interview several builders until you find one that you feel comfortable with. And I'll actually talk to that builder as well once you've decided, because we'll actually approve that builder for you and make sure that they have all the insurances that they need. We'll make sure that they have a good track record of building homes. And then you'll finalize your construction contract with the builder. Once you've done that, once you finalize the land contract, once we pre-qualified you, you can then begin the loan disclosure process, which is the process where I'll disclose the documents to you for you to e-sign, or either we can meet in person and wet sign them. And once you have that done, we will submit the loan to processing, and an appraisal is ordered. With an existing home, we'll order an appraisal to make sure that what you're paying for the home is actually what the home is worth. With a construction loan, we're also going to order an appraisal. But it's a little different because there isn't a home for the appraiser to go out and actually look at and appraise. So we collect paperwork from your builder. We get a floor plan from them. We get a spec sheet from them, which is going to tell us what sort of fixtures they're going to install, what's the flooring going to be like, the product on the roof, all the details of the construction. And if there's a contract to buy land, we also get that. And we give all that information to the appraiser, and then the appraiser will actually go out to the site where the home will be built, and they will tell us whether or not, once the home is built, what you're paying for the home and the land is actually what it will be worth. And that's a really important step for you to feel comfortable with the fact that you're not paying too much for the construction, you're not paying too much for the land, and that your home and your mortgage is going to be worth what you're actually going to pay for it. The appraiser will also go out once the construction is complete and sign off on the fact that the home was built the way that your contract states it's supposed to be built, and it was built with all the material that your spec sheet says that it was going to be built with. And the construction loan can't actually close until that's done. So we actually work to protect you during the entire process and to make sure that the home is being built the way that it's supposed to be built, and that your investment is actually a good investment. Now that we've done the appraisal and we've done the pre-qualification, and we pulled your income, pulled your credit, made sure you have the assets, the construction loan can actually close. And we will go to a title company, just like we would in a normal closing process, and you're going to sign the closing documents for the construction loan. Normally, the builder will collect a draw at closing towards the first expenses that they're going to have building your home. Now that the closing has happened and all the different safeguards have been done and due diligence has been done on your behalf, the builder can actually begin to build your home. Like I said earlier, depending on how long the builder is going to need to build your home, during that process, they're going to request draws from us for us to pay them. So we're actually paying them for them to build the home for you instead of you having to pay them, which is one of the nice aspects about a construction loan. You're able to find land where you want to live. You're able to build a brand new home instead of buying an existing home that's already been built. And you're able to work with a mortgage banker like me in the beginning of the process. We're going to make sure the builder is a good, solid builder for you. And you're able to work with us through the entire process of construction. And every time the builder asks for a draw, which normally happens about 5 times during the process, before we're actually going to give them that draw, we're going to send an inspector out to the home site to make sure what they're asking for is actually completed. So that's another safeguard that happens during the process. Once the construction is completed, the builder will order what's called a certificate of occupancy, and the county or the city building department will send an inspector out to the property to make sure the home is habitable. And once you have the CO, you can actually move into the home. We're going to then work to modify that mortgage from the construction loan, which was an interest-only loan, to the end loan. And that's the more traditional type of mortgage that you're used to, 30-year fixed rate. We also have adjustable rate mortgage products. And you would have already locked the interest rate for that before you ever began construction. And that's what I would have pre-qualified you for. So now you're going to go back to the same title company and you're going to sign a few documents. You might bring a little extra money to the, this process is called the modification. You might bring some money to the modification, like for homeowners insurance that we didn't collect at the first closing, or possibly maybe bought down the interest rate or extended the interest rate. So there might be some fees, But usually that doesn't happen, which is a nice aspect of the type of construction loan that I'm describing, because what I'm describing is what's known in the industry as a one-time close construction to perm, which means you paid the closing costs prior to construction. Now that it's modifying to the end loan, there are no more closing fees, which is nice because if you have to do two closings for the construction loan and the end loan, then it can be much more expensive than the type of construction loan that I'm talking about. Now you're going to start making that principal and interest payment, but the process is over. It could have taken as little as 6 months, or if it's a really big house with a lot of amenities, it could have taken a year and a half to build. And I'll be there with you during that entire process from start to finish. And you're now able to move into your new home. I really appreciate you watching this video. I hope that it's helped you understand the construction to loan process more. It is a little different than your typical mortgage that you may have already taken out in the past. And if you have any questions, like I said, please leave them in the comment section below. I appreciate you watching. Please like this video. And if you'd like to see more like this about the mortgage industry, subscribe. Thank you.